Hey everybody, this is Jose here. We are about to get started in just a few seconds. As always, let's have a quick sound check. I'd like to see, if possible, a quick message on the chat box where you say hello. That would tell me that you hear me, and that's why you wrote hello. So I would know sound is good, and therefore we're ready to get started on time. Thank you for that. I'll wait 15 seconds, and we begin. Thank you, guys. Thank you so much for that, Joe. Here we go. Perfect. Everybody, top of the hour, time to get started. Welcome to the session. Today it's August 21st, 2022. My name is Jose Blasco. This is a top trading session. I'll mention in a moment more what is top about. If you're new to the sessions, before we get started, I would like to highlight our financial disclaimer on the upper left side of the screen. Please read it carefully. As I always point out, it's fairly short and it's indeed very important. So please read it carefully. I'm counting you to do that. Okay. How are you, Jeff? It's good to see you as well. Wonderful. So the top sessions, Mark, how are you, my friend? So the top sessions, it's basically a type of session where we go through top as a platform. So we learn how to use the platform better and more efficiently. But also often we cannot talk about the platform without talking about trading. And often these sessions become a little bit of a lecture time as well, talking about trading. Okay, so in that sense, hopefully you're gonna have fun. It's a very rich type of session, and to make it richer, I'm counting on you guys to be interactive, to ask questions if you have any question, or if I have questions, then to give me answers, so that way we can have a conversation back and forth instead of just a little bit of a monologue, even though obviously in a webinar someone needs to do most of the talking, and in this case it's gonna be me. So before we get started, that was the introduction of the session, and here is now top, as we can see, and we are now ready to begin the session. Okay, so what do we have here? So we have the platform. For the ones of you that have been following us, have been watching multiple of the sessions, we're going through the various functionalities built in the platform, and the place where we've been exploring all sorts of functionalities throughout 20 plus sessions already, if I'm not mistaken. The place where we're going to stop today, it's the spread select tool, which is a tool that you can get if you place your mouse on top of spread, the spread button here on the left, and you click spread. So you get this tool called spread select. You can also get it if you go to file, new, right, and then you find spread select from here. Same story, you would obviously also get it there. Okay, now the spread select is a tool that is designed to assist us to build option strategies that use more than one option contract, meaning a spread. And if you were to compare, because it's often a little bit of a confusion if you think about the purpose for the strategy builder, which we have discussed in a prior session before, actually multiple times, or if you look at the spread select, well, both in the end up building spreads, right? So before I get into the spread select, I would like to mention the differences, right? So let's say, for example, you believe the S&P is going to reach that red UFO, and you right-click, send to the strategy builder with a target for 27.23, and you click on that. So then the strategy builder that we discussed in prior session shows up and builds a collection of option strategies ready to be used here. Now, this is extremely powerful, but there is a but. It's while there are many strategies, bull call, bull push, long calls, long straddles, long strangles, so multiple different things. While that's the case, obviously options trading is way richer than just basic spreads, and for more advanced traders, you may plan to do option strategies that are more complicated, or maybe you are not into doing complicated stuff. You want to keep it simple, but maybe you are very picky at selecting or making sure that your options trade meets certain criteria, for example, positive gamma values, or any other type of requirement you have for when you build options trades, and how you like to adjust them so your option strategy perform the way it is supposed to be based on your trading plan. So for that, the strategy builder, which is very powerful, then would not be the right tool, because the strategy builder is already planning, building trades, and optimizing the trades in a way that is predefined within the platform. You have three ways to kind of tweak it a little bit: selecting at the money, out of the money, way out of the money, and of course then you can define the risk and things like that. But that's it. Okay, you cannot get into I want gamma positive, I want this to be like that. You cannot do that. And also you cannot force and say, no, I only want it to be Iron Condor, for example. You don't have an option for that. Well, that's why we have another tool called Spread Select, which this one is the tool that we're going to discuss today, which allow you to create spreads by being either more sophisticated or pickier, or a combination of that and all of the above. Okay, so let's explore this tool. I'm just gonna float it so that way when I maximize it, it takes the whole space on the screen. And I'm just gonna start by pointing at certain components, because obviously this tool looks extremely similar to like loading an option chain or loading the strategy builder I just mentioned. It looks very similar. So I would like to start with showing what's similar. For example, the fact that you can click on the spread select type menu, and now you have a list of various option strategies from which to choose from. This looks very similar to other tools built in top, such as the spread tool, right? The tool that allows you to create spread. Did I say the spread tool? Sorry for that, guys. I meant to say the risk graph tool, right? So if I go back to top and you select the risk graph, so here on the risk graph, you have a menu that may resemble or reminds you of what I just showed you, right? Where you could select a specific type of option strategies to be built and then to be analyzed from a graphical point of view to understand the risk, the reward, the break-even points, and all of those things. With the spread select, the starting point, if you wish, in the upper left, is also to select the strategy that you want to build, which could be one and could be many. Maybe you are looking to build short iron butterflies and short iron condors, and that's what you want to do, and you want both of those type of strategies to be built. Maybe you are just focusing on one, and maybe the only thing you care about is to build bull call spreads, okay? And therefore you only select bull call spread, and that's the only thing you're gonna build, okay? Now, of course, I didn't mention, maybe I should have, maybe it's not even worth it to mention because it's absolutely obvious, but of course, in the very upper left side of the screen, you have the ticker symbol. So obviously, if I change this to MCD, which is McDonald's, so whatever you build will be applied to McDonald's as an underlying asset class. If you change it to AAPL, that's going to be Apple, etc., etc. Okay, so you select the symbol and then you select the strategy. Okay, all of this is very similar to any other tool built in top, as well as you select the expiration date, because when building spreads, you can force the expiration date to be selected by the trader. Maybe you have a rule that says I need minimum 60 days to expiration. So then you would go for October 21st. Okay, so maybe that's how you do it. Okay, or maybe you want to compare, as you are building the spreads, you want to compare certain parameters, and maybe you want to compare that out of 3 expiration dates. So you would select that from here. So again, depending on if you being directional, being non-directional, of course, depending on the rules that you have in your trading plan to build your option trades, so you would select whatever makes sense. Let's say you take a target, you are planning to trade Apple, which is currently trading at 171, but you are planning on a target which is located at 180, right? So, well, if your target for your trade on Apple is 180, obviously, when it comes to selecting the expiration date, you should give yourself time enough to get there. So again, how do you do that? Million ways on how to do it. You may just have a static rule that says minimum 60 days to expiration. That's what I do. And if I don't get there on time, I roll my options. Maybe you have a rule that says, look, I'm going to look at ATR values. Maybe I'm going to look at standard deviations of price projections based on the volatility cone. Or maybe my favorite way to do it is, let me move to Apple since we're using Apple. So if we said that you're going to be directional and you're going to go for 180 and this is your target, so I would just build an option trade using the spread builder, the strategy builder, because what the strategy builder is going to do is calculate the target date for me automatically. So now that I know that 9/13 is the target date, so now I could come back to my spread select and be like, okay, so I'm going to use, September 23. So I have a little bit extra time. So maybe that would be your philosophy, your process, depending on your trading plan and so on. Okay, this is just a suggestion. Of course, if instead of doing a directional trade, okay, let's say you're looking at I don't know, Merck, right? So let's say you're looking at Merck, and instead of doing a directional trade, such as a bull call spread, let's say you were to do a non-directional trade, and maybe you're doing a short iron condor. So then typically you would just leave the target price where it is, because the best that could happen with a non-directional trade is that price doesn't move. So you would just leave the target price as no target, because you don't have a target, because it's non-directional, the type of strategy you selected. And then, of course, depending on your trading plan rules, again, one more time, you will need to select your expiration date. Maybe you have a trading plan where your iron condors are always 2 week long. Okay, so that's what you do. You go for the week after the next week expiration, and that's it. Okay, maybe that's your rule. Maybe you don't do it like that. Maybe you do it more like I do it myself. If you have seen, and most of you today live, for sure you have seen it. But for the ones of you watching this recorded, maybe you have not seen it. So if you look at the live trading sessions that we do, so we often look at multiple expiration dates, we look at price ranges, we do a collection of things here, and often we end up selecting multiple expiration dates, building the same type of trade, in this case, Iron Condor, which is what I have selected. But we are now exploring the outcome of the trade using different expiration dates. All of this, of course, depends on how you trade, depends on your trading rules, okay? So, in other words, a little bit of a summary of what I said so far. You would start by selecting the right symbol. Then, of course, depending on what you want to trade, you would select the right type of strategy, directional or non-directional, bullish or bearish or neutral. You would set either a target price if you are directional, or you would just leave it the way it is if you are non-directional. Pick the expiration date, which is depending on your trading plan or your trading rules on how you set expirations. And finally, here below, you also have a target date, okay, which depending on your type of trade, depending on your intention when building the option strategy, you may just ignore these altogether, or it may become very relevant. For example, let's say you are doing an iron condor, since I was talking about an iron condor. So what's the best thing that could happen to an iron condor in a theory world, where in a theory world, the best thing that could happen to an iron condor is to expire worthless. So then you may not care at all about the simulation. So take a look at this. If I select this expiration date, for example, here, and I'm gonna get one strike here. So you have multiple iron condors that have been built for you, which I'm gonna talk more about the details of how I did that in a second. But you have multiple expiration dates, and here you have the return on investment maximum. So that means that what's the most you can make, which in the case of an iron condor is when the whole thing expires worthless, which obviously is expiration date. So if your trade is that nature of a trade, it doesn't matter what date you're gonna select here. The result you're gonna get, it's gonna be the same. Why? Because the max return on investment of an iron condor is when everything expires worthless. That's the most you can make. It's the outcome of any credit trade. Now, let's say instead of an iron condor, you are building a directional strategy. For example, coming back to the bull call spread, well, obviously the bull call spread will perform differently depending on if you reach the target or you don't, and when is that going to happen. So let's say my target on Merck was 95, right? And I was expecting to reach 95. Let me use a little bit of a longer expiration date here. So I was expecting to use get to 95, while the expiration date is October 21. Let's say I was expecting to reach my target on, let's say, September 23. Okay, kind of like 1 month sooner. Okay, so what would happen? Okay, well, what would happen is that you see we have a setting here, hide, target, and expiration columns, which has to do with that target date. So if I uncheck it, now it's going to show it. Okay, and you can see how the return on investment on the target date versus the return on investment on the expiration, it's going to be different. Okay, in other words, the P&L, the amount of money you will make if you reach the target date on the date I predefined, which is September 23, versus the P&L of the trade if you reach the target on the expiration date, is going to be $64 versus 3.36. So of course, that that is a great analysis to be done, and it tells you a lot about the performance of the trade through time, which is absolutely critical to understand. You could certainly evaluate that on a risk graph as well. But again, as you are building the trade, instead of build a trade, go graph it, find out it works or it doesn't. If it doesn't, come back, build another trade, go graph it, find out if it works or it doesn't. And if it doesn't, just come back here again and build another trade. Instead, by comparing the values in these very simple to read columns, you would understand which trades perform better than others. In this case, it's a pretty bad selection of strikes. Almost everything is red. But in any case, you get my point, right? That in this case, in the upper case, in the case on the very top, time passing helps the trade going from minus 3.3 to plus 64. So it would actually help a lot not to reach the target too soon, right? So if that was too much with your trading rules, you would accept the trade. If not, you would work on the various parameters that I haven't discussed yet here on the upper part, so you can then build the spread that you're trying to build to produce the performance you're trying to produce. But again, let me rewind. So if I hide targets and expiration columns one more time, we don't have that information here on the right anymore, which means that now that target date, has no use. Even though you can change it, nothing's going to change on the table because you are not displaying it. For you to display the changes, you will need to uncheck here. And now if instead of 923, I look at October 5. So now we are talking about, going from $59 of profit to $106 of profit on the trade on the top. So, and by the way, notice as well, which I haven't done before, that after changing the target price, I forgot to click update. And now that I click update, those columns have been highlighted with more green and less red than before. Okay, so it was my bad. I forgot to click update. Okay. But anyway, so you can see how this would work. So one last time, that target date as well as the target price is extremely meaningful and very useful to use if you are doing any sort of either bullish or bearish, meaning directional strategies. When you get into the territory of neutral trades, it's much less interesting. And certainly if you do credit trades, which are non-directional, so who cares? You can go ahead and just hide it, because then it is not useful anymore. And that's why we have the option of hiding it, because for certain option strategies, you don't really care about when do you reach a target, because there's no target to reach. It's non-directional, right? Okay, now, of course, the sky is the limit. Maybe some of you are trading directional iron condors, or maybe you're trading broken wing iron butterflies that have a directional component. So you are using a non-directional strategy, but then you tweak it to make it slightly directional. And then, you could still use non-directional strategies from this drop-down menu. But then to you, by doing these variations of the trade, then it does make sense for you to set a target date and a target price and do observe those various columns. So sky is the limit. Options give you options. There are so many option strategies and then so many ways on how to adjust it. So this tool is designed to make everybody happy, but at the same time, it's a bit overwhelming to observe unless you know what you're looking for or you're used to it. So that's why we also have the hide, target, and expiration columns option. So if you want to keep it simpler to yourself, you can certainly do that. Okay, that's really the only function of this button. Okay. What else? Well, then here on the top, so we have starting strike, we have number of strikes, we have direction, which could be up and down or both, minimum range, maximum range. So all of these basically is to tell the system how do we want the spreads to be built, right? And that would give us a long list. So like, for example, if instead of one strike, I selected 3, so notice how more bull call spreads have been built for me. If instead of 2.5 to 5, I was to select 2.5 to 10, more bull call spreads are now being built for me. So I got plenty of bull call spreads. So again, maybe the way for me to understand what is it that I want to trade would be now to carefully look at all those parameters. Let's say my trading plan says it's all about return on investment max. Let's say that's what you do. So I would say not a good idea with bull call spreads, but just for this explanation purpose, so that I guess is good enough. So if you were to do that, so you would maybe look at return on investment maximum, and you start looking down. So you got 25, 34, 45, 76, 99. So far 99 is the greatest. 127, 165 is the greatest. 357 is the greatest now. 1,200, 1,900. So you say, okay, so this is the one I want to trade. And, maybe you have done that type of analysis where you selected the type of spread you wanted, the target date, the expiration date. Then you change all of those parameters, which I need to re-explain much better. And out of changing those parameters, you've created so many trades and you concluded, the one with 1,983% of return on investment, if you're right on the expiration date, that's the one you want to trade. Okay. And then you just go and trade it, or you just go and, right click here and risk graph it or project it. And once you do that, so here's your new graph, and now you can go ahead and examine the trade. And again, if you decide to take it, you take it, and it's a happy trade. And if you don't decide to take it, then you don't, depending on your trading rules. But the point is that the tool built so many trades for you, and whichever is the parameter that was important to you, you were able to spot which is the trade that provides the greatest performance based on that one parameter, and then you took that one. Okay, so that would be a very basic application of the spread select. So again, you use the spread select to build options trades by changing those parameters on the top, which I haven't explained yet. And then basically that helps you, if you're looking for one parameter only, you can just go down and look for that one parameter and pick the one which has the greatest result, right? And that's it. That's a valid application of the spread select. But again, that is often too simplistic, because probably you tell me, look, when I do bulk of spreads, of course I care about the return on investment, but I would also like to know more about what is my time decay, what is my gamma exposure, what is the credit I collected from the option I sold, are the strikes likely going to expire out of the money, or the strikes are likely going to expire in the money, right? Because if I recall from a prior lesson that we covered, so here, for example, we have on the risk graph, we have the ideal strike zone, which if you have been watching prior lessons, you know what I'm talking about. And so, here you can see an example of, a call. This is just a long call here. Okay, long call right here, right? So here you have an example of a long call, which is well set for the strike selection, in this case, the 422 call, to be selected based on utilizing that ideal strike zone feature that we discussed in a prior session, thanks to the Russian mathematician. Thank you very much, Mr. Chebyshev, for that powerful theorem, right? So let's say you wanted to add that here. Well, guess what? You don't see it on the list. You don't see. You can see your gamma, you can see things like that, but there are many things here that you wouldn't see. Like maybe you care about what is the probability of in the money of the option. Okay, there are many possible rules that you have in your trading plan that you would not see here. So how can you deal with all of those other possibilities that are not part of the columns? Well, that's when the option spread select filter comes into place. Okay, there is an option that also clickable that could be checked or unchecked. By default is unchecked. But when that option is checked, so notice what happened. So we have a column here called the option spread filter, which is blank. Okay, there are no returns, right? But if I check market, now next thing you know, I got fail cases and pass cases, right? And what are those failed cases and pass cases? Well, those are going to be based on the parameters that you input to that particular filter, which by default is using the factory settings. So what are the factory settings? Well, if you click on the settings wheel, this is what you get, which again, it's also quite intimidating if you have not seen it before. But if you look at it carefully, it's way simpler to understand than what it looks like. And here, for example, just to keep it very simple, you may say, look, I want to apply for the long leg that the options I buy are in the shaded area of the ideal strike zone. Maybe this is something you want to do. And for the short legs, notice that there is no requirement here to be applied, but maybe you want to check mark the short legs and select that the short legs, I want them to be outside, right? And maybe you even want to say, look, but when I sell the short legs, I want to collect at least 30 cents. Okay, if not, I don't want to sell that short leg. So if you want some of those additional conditions, which I'll come back to this menu, and you click OK, And then you look at this column, notice how the fails and the passes have changed. You can actually even double click on the header, and now all your passes show on the top, and all your failing spreads, the spreads that don't meet the criteria of the filter, will show as fail. Therefore, now instead of focusing on that trade that provided 1,900% of theoretical return on investment on expiration date, which of course it was so amazing because the options were extremely cheap. And therefore, if you're right, you're going to make a killing. But because the options were very cheap, the probability of making money with them was very low. So those options would not pass the filtering criteria of the ideal strike price zone. And therefore, now you can see that under pass, you have 127, 165, 168, 221, pretty good return on investment metrics, but you don't have the 1,200 plus that we saw before, isn't it? Because that would be a strike. Actually, it was 1,900. That's a strike. That's a spread made of strike selections that will not provide the parameters that we have selected. Okay. For example, if I zoom in on the bid price, okay, the option that we sell would only pay 2 cents. Well, we made it a condition to be paid at least 30 cents, right? So again, multiple conditions here would not be met. The ideal strike selection would not be met. The credit collected way selling the option would not be met. That's why the result is fail. So in other words, now, if you enter the right type of filtering condition after working on all the options available above, which I still have not explained and I need to explain. So you work on all those options above, then you set your filtering conditions, and then the only thing you need to do is to sort based on that option spread filter column by clicking or double clicking on the header. And next thing you know, now you will have an automatic list of trades that pass and trades that fail. And that is very powerful when it comes to number one, saving time. Number two, not making mistakes when building your spreads. But also number three, many times without expecting it, maybe take advantage of some price anomaly that may happen on a certain strike. For example, Joe, you are with us today. The other day you were talking about that amazing strike on the USO ETF, isn't it? That had huge, massive volume. So precisely because of so many trades, maybe that strike was very distorted when it comes to its pricing. You may have a price anomaly and you may have an extra benefit by either selling that strike or buying that strike. And guess what? That would translate into very powerful return on investment metrics with a pass filter. The two things combined, now it's really powerful. Okay. So anyway, so far I've been explaining how this tool works, but at the same time as I was explaining how the tool works, I was a little bit also of giving you a little bit of a tour to the tool so that you understand the purpose behind the tool, because I'm going to get deeper into how it works, but without understanding the purpose, it would be a bit abstract. Okay, so I wanted to have a little bit of a mixed conversation where I was talking about how it works, but also give you a tour, right? So now that you have seen it and you know kind of like how it works, even though you are lacking on detailed explanations from me coming in a moment, I'm ready to dive deeper into all of this, okay? Also, of course, as always, I'm ready to take my sip of water and ready to listen to you guys on how is it going so far. If all is going well, please let me know on the chat box all is good. If things are not going well and you need me to re-explain something at this moment in time, let me know before I dive deeper, so it's all well understood. Thank you so much, guys. Okay. Okay, so I would say all is good. Wonderful. Perfect. Thanks a lot, Mark. So anyway, so let's dive deeper. Okay, and again, to dive deeper, let me close it, open a new one, so we kind of start again. Okay, so actually let me float it so I can maximize it all the way, and it takes all the real estate space on the screen, which probably helps. So again, let's start again. So we got Merck. Okay, let's change this to another stock. So, for example, we could use, let's say, Johnson and Johnson, for example, just to pick one. So, the moment you do that, the name shows here, Johnson and Johnson. And of course, the first thing you have to do is to select what is the type of trade that you want to select. By default, it comes with a bull call, bull put, and bear call. This has no meaning, no intention. Just uncheck it and just check whatever you want. I'll start with a bull call. Okay, so we have a starting point, but then I will demonstrate other applications. So we are trying to build bull call spreads on Johnson and Johnson. Okay, thanks for that, Joe. Yeah, not sure what happened, but I see you now. So now we are directional with Johnson and Johnson. So let's say we have a target. Let's say the target is located at 177. So I just did that. I click update. I didn't forget this time. And then, of course, because we are being directional, it is definitely very useful to select a target date. So then later I could compare the performance of the trade on expiration or prior to expiration, which in the case of being directional trading is indeed relevant. So I am going to uncheck hide target so I can show it, and I am going to select a target date, which obviously will be maximum my expiration date. Notice how by default it is going to show you September 16, which is the same as the expiration date. So let's say you have a rule that says I use 60 days expiration. Let's say that this brings you to use October, but let's say when you did your calculation for the target, let's do it. Johnson and Johnson 177. So let's say we go in there. So the expectation for the target date would be September 20. Okay, September 20 would be the expectation for the target date. So I'm going to go here to September 20. Okay, and with all of that, click update. Okay, so I got, if you wish, the 4 parameters on the left selected, which is the type of trade, the target, the expiration date, and the target date. Okay, so I have all of that. So now I am ready to start building the spreads. So I could look down and either manually select the spread I want to trade or use the filtering conditions, right, with this sortable column on the right, option spread filter, which personally that's what I use all the time. Okay, even though you could certainly look at it manually and confirm if the trade that you're going to take are valid or not. But before you do that, you need to build the spreads. In this case, by default, the way the system it's pre-configured, it built 2 spreads for me using October 21st expiration. That, of course, because I changed it. But then you have the 170, 175, 170, 180. So notice that by default, we have a starting strike that we have not selected that came by default, which is, guess what? It's the at-the-money strike. The current price of Johnson & Johnson is 169.31. The nearest strike is 170. Therefore, that's the at-the-money strike, and therefore, that's what came by default. So you could certainly change that. Maybe you have a rule that says that, look, I'm always out of the money. I'm always in the money. So maybe you have a way, you have a rule, and therefore, you would come in here and change it and pick another strike selection. Okay, so that's one way to do it. I personally don't prefer to do that. Okay, like if you think of a bull call spread, again, there are many different ways to act here, but a bull call spread is made of you sell a call at a higher price and you buy a call at a lower price. So if the call you're gonna buy is gonna be at the money, which in this case is the 170, right? So the call you're gonna sell is only gonna be higher. Right? It's only going to be higher. In this case, the 175 and the 180. Okay? But look, the reality is that there may be other combinations of spreads. Again, especially if you're looking for price anomalies, where maybe you buy an out-of-the-money option. Maybe you buy the 175, which is typically not recommended, especially in this case, $5 of strike price increment is not too good, I would say. But bear with me on that. So let's say you were to buy an out-of-the-money option and then you sell an option much higher. If based on options theory, if you wish, that's probably a bad idea. Even though the return on investment will look brilliant, but the probability of profitability is probably poor. But at the same time, if you do have some extra advantage on on options prices anomalies, and maybe that that 185 is extremely expensive, and you make the trade so cheap that even though the probability of profitability is limited, it actually makes sense to do that, because then even maybe during the life of the trade you convert your bull call spread into a butterfly or something like that, and next thing you know, you have in no time you have a risk-free trade. Again, you never know. My point is that there is a lot of moving parts in the world of options trading, and because there are many strikes in an option chain, sometimes you are surprised. So because of that, I prefer to analyze the whole set of possibilities, and I love to look at both under direction, which means that starting with the 170 strike, I would like to look at what happens if I buy and sell options above and below both 170. Okay, I personally like to do that. And how many strikes above and below? Multiple strikes. The more you build. So I personally prefer to do it like that. But now your trading style may be different, and you may tell me, no, look, I like to start in the money. So to me, it has to be in the money. That's my style. I make the trade more expensive, but it's more reliable, whatever. So you're like 165 is what I'm looking for. I'm not looking for to go below that either, because it's too expensive. So I'm just going to look at combining 165 with multiple strike above 165. And, if you were to do that, so, certainly, that could be a way to do it. But in my case, again, as I said, and probably it makes it also a more universal process, if you look at both above and below, and instead of building, 5, 10, whatever, what I normally do is type 99 and I build them all, right? So many. And you're gonna be like, well, that's a waste of time. It's too many options you don't need. Yes, but then I will come to the filtering column and just sort it, and then I only see what I care about. Even though my list is very long, what I care about is on the top, which are the ones who pass. Okay, so that would be my recommendation from a process point of view. Of course, all of this is for you all to play with, to have rules around in your trading plans and so on. But that's the meaning, right? So the starting strike is, as the name suggests, the starting strike to build the spread. A bull call spread is made of 2 strikes. So you got 170 and something else, 170 and something else. That's the starting strike. Let's say instead of a bull call spread, you are doing a long butterfly, right? So 170 is going to be the strike in the middle. You see that? 170 is going to be striking in the middle. Let's say, but that's still your starting strike. Let's say instead of a long butterfly, you are doing a short iron condor. So now 170 cannot be in the middle because it's 4 units. So you cannot be in the middle. And you can only be in the middle if it's three strikes. In this case, it's 4 strikes. So it cannot be in the middle, but it's there in the second place. And notice how you got things above and below 170, right? So same story. So the philosophy is, what's your starting price? So again, if you are looking into selecting manually direction above or below manually, it's very easy to make mistakes, and you are now above 170 or you are below 170 and you want it to be above, or vice versa. Where if you select both and you just input a large number here, 99, and then you work with the filtering conditions to get only what you care about. So, again, in my mind, this is a much more efficient process. I didn't have selected the option filter, sorry about that. So in my mind, this is a much more efficient process where you only see what you care about, but you don't need to think too much when you are selecting those parameters all the way to here. Okay, the 2 on the right will have a greater impact, as I will say in a moment. But those 3 parameters, okay, the starting strike, the number of strikes, and the direction above and below, again, you can use it in what I would call autopilot mode, right? Which is just start where you start, which is given to you automatically at the money, and then add many strikes, direction above and below, both. And you're going to have many spreads. Then you filter them out, and you get what's there for you. And whatever is failed, you ignore it. Whatever is passed is what you analyze. Okay, so that would be the process that I enjoy the most, that I feel makes the most sense, even though you can certainly make it more manual if you wish. I like to use the spread select as semi-automated way to build spreads, because obviously the automated way to build spreads is just to right-click and go for the strategy builder that just build the spreads automatically for you, even though it's a set of strategies. Is not the whole complete amount of strategies which are available in options trading. Is a specific set, right? So going back to here, so now that we know more about the starting strike, the number of strikes, which I'm going to delete for now, and the direction, okay, above and below both. So I want to talk about what's the use of minimum strike as well as maximum range, right? And again, this has to do with the distance between strikes in your spread. So in a bull call spread, and again, each strategy is different, but with spreads, you always have the distance between spreads, right? So for example, if I sell the 175 call and I buy the 170 call, so I got $5 of difference, okay, or distance between strikes. If I sell the 180 call and I buy the 170 call below, then the distance between strikes is $10. And of course, this has multiple implications. If you understand options trading, if you have taken an options trading course, you probably know or remember that the greater the distance between strikes, the greater the delta, but also the greater the delta, the greater the cost. And also the greater the cost, the greater the risk. Where the lesser the distance between strikes, in this case, you make the trade cheaper, but also you have less delta, but also because it's cheaper, you have less risk. So you may have ways on how you build your trades. And apart from having ways on how to build your trades, which are your preferred ways on how to build options trades, which should be, or maybe definitely should be, part of your trading plan, apart from that, there is also technical aspects of how options trading works, and in this case, spreads, where no matter how you build it, there are certain things that are the way they are. So for example, if you take a trade on the 170, 180 spread, and the stock goes all the way up, and the stock ends up at 180, but it doesn't matter the stock is trading at 190, because since it's a spread, is it a limited risk, limited reward type of trade, and above 180, you cannot make more money. It's impossible. The most you can make is when you get to 180, right? So it doesn't matter that the stock went to 190, so you cannot make more, right? So what I'm trying to say is that, okay, let's say you're looking at the chart when you plan your trade, and you have a red UFO located at 190, right? Well, so if your target is going to be like 190 because you have a red UFO waiting for you at 190, well, then probably you should not sell the 180. You should sell the 190 or above, because if you sell the 180, you're going to be capping the profits of your trade. Okay? So again, even if you didn't know that and you build 99 strikes, so then the performance will show much better for the one that has a strike beyond 190, right? But in any case, it may save you a little bit of time when you are building your options trades to know those things. So now you can come in here and be like, look, if my target is going to be 20 points away, I better take maximum range of 20 points, because I need at least 20 points of distance between strikes to make a decent profit, given the fact that my next UFO is 20 points away. So you actually may go a bit bigger than that. Maybe you go to 30. So now between 5 to 30, you build 99 spreads, right? And then you sort them based on their criteria. And now you have a greater amount of possibilities that pass the filtering condition. And now you can get into looking at percentages of return on investment, okay, and behavior of the trade, okay? For example, this trade that makes 72% makes 72% if you get to the target on the target date. But if you get to the target late on expiration, it makes less. Where the trade below makes 62% if you get to the target on time, but if you get to the target late, you actually double the profitability. So in other words, time decay actually works on your favor, even though it's a debit trade, given the theta switch point. So then you have time decay in your favor if you were to reach the target. If you don't reach the target, forget about it, of course. But if you do reach the target, you actually increase your performance. So so now you can look at this low limited list of pass opportunities and pick the one you like the most. And of course you can use the other tools built in the platform, which I'll just flash, even though I won't discuss it today. You can just risk graph it, and when you risk graph it, now you compare this trade compared to the other trade, you look at break evens, etc., and you will decide which one is for you given the rules of your trading plan. But again, from here, just by looking at this, you would be able to select almost with precision at least one or two, probably not even more than two, just by looking at the grid, that are basically the one or two trades that you will want to take, and ignore the rest. Even though they pass the filter, here in this list there are one or two that may make you the happiest based on your conditions. And that, by the way, is without having done too much with the filtering conditions, because I didn't add, for example, what if you need a minimum delta of 25, but you want your delta to be maximum 40, right? So if you were to do that, right? So notice now how only two trades pass, and now it's a very easy decision. Okay, it's a very easy decision. So one makes 53 to make 95, one makes 72 to make 102. Guess what? Making 72 is more than 53, making 102 is more than 95. No need to think. You do the 170, 180, that's the trade you take. Done. Right? So it's very simple. That's the purpose of the spread select tool, to build many spreads. So if you can catch price anomalies to your benefit, you're going to catch it. That's why we build 99. But then use the filtering conditions to narrow down the search to your very specific rules that are part of your trading plan and how you like to trade options, okay, and what are your preferences in your trading. So now I would like to change the type of trade for a moment, and then I need to talk about the filters, and then we will conclude the session there. So I would like to talk about trades. Instead of directional, I would like to talk about non-directional trades such as iron condors. And let's change the symbol. Okay, for example, we're going to do PayPal, pick another symbol. Okay, and in this case, again, just to make sense, typically iron condors are of a shorter duration, so I'm going to go for 19 days. Target price, we don't care. Target date, we don't care. Hide target or expiration, I'm going to hide it because it's an iron condor. So let's say you want to simulate the iron condor until expiration, or maybe not. Maybe you want to simulate the iron condor to a specific date, so you could certainly do that, as we saw before. And now I want to go ahead and talk about, those parameters above. So we have a starting strike of 95, number of strikes, as you know, I'm going to type 99, direction both, I'm not going to touch it. So I made my point earlier. But here now, notice how it shows a starting range of 1 all the way to a starting range of 5. Well, you may be looking at PayPal as a $96 stock. And again, depending on your risk appetite, your trading rules, and so on, and probably that when you do an iron condor, the maximum risk you get is the distance between strikes. Well, if the distance between strikes is 5, it means that you are risking $500 per contract on a $100 stock, which to me, that's exaggerated. To me, that's too much. Okay, again, that's based on my trading rules and my preference. Maybe you disagree, which is fine. Maybe you agree, which I would agree with you if you agree with me. So now, what if you wanted to change that from 1 to, let's say, 2? So notice what's going to happen. Or let's start 1-1. So if you do 1-on-1, notice that your iron condor is going to be 94 to 95 to 96 to 97. Okay, it's 1 is 1. That's it. But what if you do 1 to 2? Well, now you're going to do 93 to 95, 97 to 99. That is $2 of difference between the strikes. Where below, you have 94 to 95 and 96 to 97, which is 1. So in other words, I'm doing the simulation for $1 differences between the strikes, $2 differences between the strikes. So in the case of a spread, typically you do it, especially if it's a directional spread, like a bull call spread, you play with a minimum range and a maximum range based on where your target is. You want the maximum range to be at least where your target is or beyond, which is what I've done before. But what if you're doing non-directional trading, such as an Iron Condor, where you do credits and the most you can lose is limited by the spread minus the credit collected? So the spread will provide a risk which is directly related to the distance between strikes. Therefore, you may work on these values, minimum range and maximum range, depending on the risk appetite or the rules of your plan, which are supposed to be in line or in tune with your risk appetite. Okay? So this is something for you to keep in mind, that even though the function of min range and max range is the same, which has to basically move the strikes, right? The purpose and how you act on those values may vary depending on you doing a debit trade or a credit trade, directional, non-directional, if you are focusing on maximizing profitability out of a move, or you are focusing on minimizing risk out of distance between strikes. So again, I guess it makes sense. You may need to re-listen to this using the recordings, but I guess it's quite logical. One more point here is also the fact that if you select different expiration dates, okay, let's say, for example, I'm looking at something very long term. So, PayPal, to be honest, it's very liquid as a stock. So I believe that the expiration date I selected very far out is also providing no, correct. Okay, here we go. So minimum range, if I only select June 16, that's what I wanted to show you, it's 2.5. That's the minimum. Notice how 1 doesn't show anymore. So if I select a long-term expiration date or an expiration date that is less liquid, and then I select a short-term expiration date, so notice how the minimum range is automatically detected by the system and you are provided with what's minimum. Same happens with what's maximum. Of course, if I select 1 and 5, so it will certainly build $2.5 of strike price increments as well as 5. But just know that the expiration date basically will impact what are the values that you get in the drop-down menu here, minimum range and maximum range. Okay, cool. So again, you've done your spread. We now add 99. Okay, now we got 99 Iron Condors. Now you want to filter. So you select the filter, okay, and now the moment you select the filter, so then it would be time to filter that filter column, right? But notice how it's all blank. Why is it all blank? That makes no sense. Well, it does. Let's go back to the settings wheel, okay? There is a setting all the way here on the bottom that says only apply to long call or put, short call or put, bull and bear call, bull and bear put, and diagonal spreads. Okay, so obviously what we're doing now is an Iron Condor is none of this. So if I don't uncheck that setting, okay, that column is going to be blank. If I uncheck that setting and click OK, now this column has information. Okay, this column now has information. And now depending on what we type in here, okay, now we're going to have approvals or rejections for our trade. So for example, you are doing non-directional trading. So maybe you don't care about the long legs. You care about the short legs. You want the ideal strike zones to be outside. You want to get at least 35 cents per options per contract sold. And then maybe because it's non-directional, you want to make sure that you don't care about a minimum delta. You care about a maximum delta, which you want it to be maximum 15 delta. And if that's what you want, you now click OK. And when you filter that column, now you get some passes that allow you to now look deeper into this trade and see which one you like the most. Okay, so it's the same thing. Okay, same thing as the directional opportunities. You just need to, I guess, spend a little bit of time looking at all the options inside option spread filter to be able to input whatever it is that you need. Now, the good news is that once you have spent time, which could be a decent amount of time to find out exactly what is it that you want to input here for the trades that you're looking for to be found, the beauty is that you can save your parameters as templates. Okay, as you can see on the bottom part of the screen, okay, there is a Save Template button. You can even make it default, okay, or go back to factory settings if you made it as a default by mistake. And then once the template is saved, you can always load a template. So for example, I have a template which is already ready to go for Iron Condors. So if I open that template, automatically, take a look at what's happening. So automatically it's telling me that the options I buy will be outside. Okay, we don't want them to be high probability. Actually, we want the whole thing to expire out of the money. So we want them to be low probability. The options that we sell, okay, we want them to be outside. Okay, we sell them, but we want them to have a high probability of expiring out of the money. So we want them to be outside the strike zone, the ideal strike zone. The midpoint, we want it to be at least 35 cents. Okay, and also we want the probabilities of those options to be maximum 30% when it comes to expiring in the money, and maximum 25% when it comes to breaking even or better. So we have a low chance for that money, for those options, based on the options pricing model, to let me rephrase that again. We have a low chance for those options to be in the money and therefore to hurt the trade, and we have a higher chance of those options to be out of the money and therefore expire worthless, which is the ultimate goal of an Iron Condor in this particular example. Okay, what else do we have? Well, that was for the long units and the short units. Okay, then we have the net spread, okay, which is the combination of all those units together. But before I talk about the net spread, notice that you can also apply the conditions for the long legs to only one long leg, or all of them must pass. Okay, or same for the shorts. Apply this condition to only one leg, or all legs must pass. Okay, and then coming back to what I was saying, then once you have specified all the rules for for your parameter, for your spread, so then you can also, for your legs individually, so now you can work on the spread itself, what we call the net spread, and specify delta values, gamma values per leg, but also gamma value when you reach the target. Okay, when you reach the target. And let me rephrase that, because this is not per leg. Okay, this is not per leg. This is for the total amount of legs. That's why there is an S at the end. For the total amount of legs is the net gamma value of the spread overall. Sorry for having said what I said, that was incorrect. And then we're also looking at the gamma at the target, okay, which again, in the case of a non-directional trade, doesn't make sense, and also the vega, right? And finally, here on the right, you can also set minimum requirements for reward and risk. Could be a maximum risk or a maximum profit. Could be the return on investment on the expiration, or maybe the return on investment on the target date. So you could certainly vary all of those things. Okay, and with all of that, so you just click OK, and that would filter out that set of 99 Iron Condors, giving us passes or failing conditions that would allow you then to go ahead and right click, analyze further this trade, knowing that it passes your rules, and then if the trade is good, then to go ahead and execute this trade in a trading account. And that's the spread select tool, my friends. Okay, and again, the best really is to utilize it, because there are many subtlenesses around it as you are utilizing it, depending if it's directional, non-directional, debit, credit, close targets, far targets. So there are multiple subtlenesses which basically imply you understanding the option strategies that you use, and therefore customizing the settings, and in that sense, filtering out in a smart way which trades you want to keep, which trades you want to discard. But hopefully today's session, which we are just reaching its end, was good in the sense that it described not only what is the spread select tool, but also how to use it for different type of strategies, and how to tweak and vary the various parameters, the various, work on those various drop-down menus and clickable, checkable options, and so on. So you end up filtering the way you want. So you end up, again, saving time, avoiding mistakes, building your spreads, but also ideally taking some advantage of price anomalies that may be out there that we don't see when we look at the option chain because we're only human. But when you process it this way, now you get a pass and you get a great return on investment number, and that means this trade is more powerful than average. So that's the one you would want to trade, I would say, isn't it? Anyway, my friends, I'll just wait a few more minutes here, a few more seconds, I should say, because we reached the end of the session to read your comments on the chat box. How was today? Any remaining question about something I did not address? I'm happy to stay a little longer if that's needed, guys. Okay, that's not a problem. I just try to be respectful with your time. How was the session? How did it go? Any question? Any suggestion? I moved quite fast into the material, so some of you may need to watch this recorded again. But to make it fit in 1 hour, I had to speed up a little bit, so hopefully it was not too much, and you guys were able to follow me well, okay? Thank you, Mark. Thank you, Joe. Thank you, Jeff. Wonderful, guys. You guys are great. You are always so kind to me. So this is really, really a pleasure. Again, the best thing now is to add a little bit of homework on your end, guys. You guys practice the tool. And for sure, join us in any of the sessions, either during the sessions that we do during the weekdays with trading, as well as during the sharpening sessions on the Saturdays, right, where we do option stuff on top. And we can certainly go deeper into this, okay? Mark, what are the templates for bull put and bear call spreads? So if I load the template, okay, the bull call and the bear put are directional debit strategies, okay? The bull put and the bear call are two templates that I have not built, okay, that I have not built, or I don't have here, I should say, in this folder. But there would be a mix between what the iron condor does and what the bull call and the bear put does. So if you want me to kind of go over it. So again, when doing a bear call or bear put, what you're looking for is options that expire worthless. So on the long leg, you will want them to expire worthless. So you will want that to be outside, okay? And I would say that's good enough, unless you have some requirements for volume, open interest, which for sure you can add. On the short leg, it will be like the iron condor. You will want to select the options that you sell to be outside. Okay, you will want to have a minimum credit to be collected with the options that you sell. Okay, and again, you can work like what I've done on the iron condors. You may want to work on probabilities. I had 30 and 25%, if I'm not mistaken, because those settings will help for the options, either the puts you sell or the calls you sell, to remain out of the money until expiration, at least based on probabilities, right? When it comes to the Greeks overall for the spread, really for a credit spread, unless you make it directional, it doesn't really matter. So I would just uncheck the whole thing, unless you want to get very picky with your gammas and things like that, but I would say it doesn't make sense really. And then when it comes to reward and risk, so same that I've done. So you will want to get a return on investment, a minimum, let's say for example, a minimum of 25% or something like that. Okay, and that would be it. So if you think about it, this looks very, very similar, if not exactly the same as what I have for the iron condor. So you can certainly do that, okay, because that's what we're doing. Okay, now you tell me, look, but because it's a credit spread, while it's neutral, I want to have a little bit of a directional component in it, but not too much. So maybe what you want is just to add a delta of, maybe maximum 15 delta, something like that. Because of course the minimum would be 0, right? So it's purely non-directional. So you may want to have a little bit of a delta, but not too much, right? So you make sure that those units are fairly out of the money, directional, but not too much. So that could be a good addition, okay? And also depending on your sensitivity for volatility changes during the life of the trade, again, you may want to add a minimum, maximum condition of Vega, okay? This has a direct dependency on the expiration date that you use. If you use a short expiration date, Vega is going to be very low. But in any case, if you want to keep it very low anyway, so maybe you end up with 0.1, something like that. again, in most cases, I would uncheck it and that's it, good enough. But yeah, so something like this may make your filter to be just a bit more sophisticated than the one for the Around Condor, because the Around Condor is totally non-directional, but with a credit spread, you may have a little bit, tiny bit of a bias in one direction. So this is how you could adjust it. And again, as long as all those rules line up with your trading plan rules, so then you are good to go. Okay, that would be kind of like the approach. Then when you save this as a template, you give it a name and you have it. Okay, great question, Mark. Very good question. My friends, everybody, it's been great to spend this time with you. You guys know this is not the first time I say it. I have a special extra thank you for you guys when you join me over the weekend. It means a lot that you take weekend time to join me live, because you could certainly watch this recorded, isn't it? So thanks for that, and keep up the good work, everybody. See you during the live sessions during the weekdays, and again, anything you need, we'll be around. By the way, check your inboxes, guys, because in recent times we are sending a collection of emails which are relevant, such as a big update that we have in some of our servers next week on the 24th. So make sure that you know that. Also, you have some surprise emails coming in very soon, especially as we approach the end of the month. I'll tell you a little secret, guys. We are about to release our first book. I am super excited. It's been a 2-year work book, and it'll be available for purchase very, very soon, and we'll be notifying that on an email blast to all of our community. So just again, sharing my happiness with you guys here on how excited I am. Okay, but anyway, keep up an eye on your emails, because again, there are multiple announcements that we'll be doing in the recent couple of weeks. Okay, take care, everybody. See you soon. Bye bye.